Welcome back to the Isn't That Rich podcast. Today we are talking all about refinancing loans, and we have our Harrisburg loan officer, Taylor Abney, joining us today to share all about what the refinancing process is and all of that good stuff. So we're excited to have her on today.
Yeah. Welcome on, Taylor.
Yay, thanks for having me, guys.
First time on the podcast.
Yes, super excited. Super nervous.
No need to be. You'll be great. So Taylor, you've been with farmers for a while now. Tell me how you got started at Farmers State Bank.
Okay, so I started in January of 2017. I recently, before then, had sold real estate for 5 years. And then worked in my dad's accounting office, and I kind of wanted the best of both worlds. So it led me to lending at the bank. So it's kind of not showing houses, but still in the house sector and still looking at people's financials. So best of both worlds.
Yeah, I feel like working in the real estate world must have given you kind of a leg up when you started. You kind of saw the process from that, and it probably makes you more relatable as a loan officer, I would imagine.
So I feel like it made me know how important it is to meet those deadlines for the realtors. The realtors depend on meeting the deadlines for their pay, basically. So just keeping them up to date and knowing what was going on. I know that was always super important when I was selling real estate. So I tried to be courteous and, keep them informed and meet all of their deadlines that they've made on contracts. So it's super helpful. For sure.
Yeah.
So there's been a lot of talk in the news about interest rates fluctuating, going up, going down. We're not really sure what's going to happen. But with interest rate fluctuation comes a lot of talk about refinancing. Can you give us a brief overview of what refinancing is?
Sure. So refinancing would be taking your existing loan and redoing it. Whether you're taking your term down from a 30 to a 20 or 20 to a 15, or just getting a better interest rate on your loan. So it's basically redoing your whole loan to do a better term or a better interest rate.
Gotcha. So why would someone want to refinance? So say they've, got a fixed rate for 30 years. Why would someone want to refinance?
So the big reason is to save money, of course, on their monthly payment. Secondly would be if they, had some equity in their house, and a lot of people right now are refinancing because they have the equity in their house and they're wanting to pay down debt because interest rates are really high right now on buying vehicles and credit cards. So a lot of people are refinancing to pay down debt that is a higher interest rate. And then a lot of people refinance to remove what we call PMI, which is private mortgage insurance. That is a monthly payment that is in your monthly mortgage payment if you have not put down at least 20% on your loan. So a lot of people are wanting to refinance on that to get rid of that extra monthly payment because they have built up equity in their home, or their home will now appraise for more to where they will meet that 20% equity in their home.
Oh, got it. So if you don't have that 20% down, you're paying extra for insurance on your mortgage that you wouldn't normally have to pay.
Yes, you have that PMI insurance. So it does vary in percentage with what you put down. So if you put down 5%, your PMI is higher. If you put down 10%, 15%, it goes down each month. It's variable on what you put down.
Can you explain private mortgage insurance a little bit more? Like, why is that a thing? Is it a law? Like, why is that a thing for people?
So I think it just covers, the bank because you don't have a lot of equity in your home yet. It's just something that's extra protection for us until you meet that
in case
percentage.
Something like, what if you were to pass away or like not pay your mortgage bill.
Yeah, but getting rid of that PMI would be a huge benefit. So they wouldn't have to pay that extra.
It's an extra, monthly fee that is in your loan payment.
Yeah. And if it's like, say, $100 a month, I know I would love to save $100 a month if I didn't have to pay that.
For sure. It could be as high as 100, or even I've seen it be over 100 a month, based on credit score and percentage down and things like that. So
yeah, and probably how big your loan is, right?
It's a chunk each month.
So it sounds like there's lots of positives for refinancing a house.
Yes, there are.
But I'm assuming maybe there might be some cons, maybe.
Right.
Are there any cons to refinancing?
So I always tell people to look at how long are you going to live in this house once you refinance, because we have to make sure that they're going to recoup their closing cost. And usually it will take a couple years for them to recoup the cost of closing. We've got appraisals and title work and loan fees, and we can always put those back into the loan to where they don't have to bring those if they have enough equity in their house, but then you're just adding more money to your loans. So I always tell people, look and see if you're going to live there for at least the next, I say like 5 to 10 years, because if you look at the picture of 3 to 5 years, usually you're recouping most of it or all of it, but you're not really paying down any of your principal. So that would be my biggest con to it, is to make sure that you're going to live in the property for at least another 5 to 10 years.
Yeah, it's not something you would just want to do because the rates dropped. It might not be low enough to outlive the equity you would build.
Right. And it's not a service that's like free.
Right. It's not free. And then
there's so much work that goes into that. I don't think people understand.
And then you're running credit. You're doing a hard hit on people's credit. So that's another big one. You want to make sure that they realize, like, we're doing a hard hit on your credit. So your credit is going to go down when we run it. So that's another, big deal. If you're not going to live there for that much longer, now you've got a hard hit on your credit, and now you've got all these new closing costs and things like that. So you really have to think about, all of those things.
Yeah. So rather than refinancing, is it time to look at a new home, things like that.
Right.
Yeah.
For sure.
So say we were thinking like maybe the rates are going to drop in the next few months. Who knows what's going to happen? How do you calculate as a home buyer or home owner who has a long-term loan and are thinking about refinancing? How do they calculate that? Is that something you can do as a mortgage lender, or what does that look like?
Sure. So usually I will show them how much interest they are saving between the two loans. So I will do their current interest rate if they're at a 30-year, and then I will show them the new interest rate at a 30-year, and I'll show them the interest for the 30-year and the interest for, the 30-year with the new interest rate. And then, subtract that and figure out how much interest they are actually saving. And then I will add in their closing cost to kind of show them the broader picture of how much they're saving over the life of the loan, including their closing cost, and just tell them if it's worth it or not.
Yeah.
Usually I don't even try to contact people until they're at least a percentage point under their current rate. And I usually like for them to be more. A percentage is good, and you will save money if you're going to live there long term. But usually I like it to be at least 1.5 to 2 under what they are.
That's a good rule of thumb.
And it's amazing how, because I've done some calculations like with my home, and it's like, it's amazing how much 1% can save you on your interest.
Right. And it needs to be 1%. It needs to be 1% under. But you also want to look at the interest you're paying at your current rate and then the new rate, subtract those and then add in your closing costs too, because sometimes it doesn't add up for people. It just doesn't make financial sense for them to go ahead. But usually that is my biggest rule of thumb. If you're, at a 7.5, you need to at least see the interest go down to 6.5 to do anything. So.
Have you ever had anybody that it's been less than 1% and they're just adamant on you refinancing?
Yes. So
because they think they're saving money, but really
they do. Actually, a lot of people that do that, I feel like it's the ones that have the equity in their home and they want to do the cash out to pay down other debt or remodel. So they're not really caring if the interest rate is 1% below. They're more concerned with doing the cash out, taking the money out to do other things. So the percent's not really, their focus.
The rates, not their focus. Neat.
Yeah.
So is it always worth refinancing if the rate is lower? Or are there situations where maybe, you talked about if you're not living in the house, more than 5 years, but are there other situations where it wouldn't be worth refinancing?
I think a lot of people in the economy right now have a lot of debt. And so, you're looking at hitting their credit score, like I said. And a lot of people, honestly, the credit score has gone down for a lot of people over the past couple of years.
Really?
So you're hitting it hard again. And, that could be make or break for a lot of people right now. You could be at a 660 and then we would take you down, to the low sixes. So I feel like you need to have a strong credit score right now if you're planning on refinancing. The living in the house, are you planning on, staying there? Are you planning on, looking for another house? I think you just have to look at like the feasibility of what their long-term plans are. Are they planning on having to go buy another car and their credit scores dropped? Are they planning on trying to send their kids to college and they need, to save as much money as they can? So you're putting the closing cost and things back in. I think you just have to look at like the whole situation.
Yeah, for sure. And I think the closing cost thing, like you really have to, for me, I feel like that'd be a big thing in my life right now. Like I would consider like, is it worth the closing costs for me? So some people, really don't have
a couple $1,000s.
That's what I'm saying.
So to me, personally, I probably wouldn't want to add that back into my loan because that's just adding more money to my loan that I'm trying to pay down faster.
Mm-hmm. Yeah.
So,
really got to crunch the numbers. It sounds like
you really do. Like it's a bigger picture than what most people think. They think rates are down.
Refinance.
Let's go.
Yeah.
But I think you have to look at, a lot of different factors.
Mm-hmm. And as a loan officer, you're asking all these questions. There's so much more. Because when I walk into a bank, I just think, okay, this is what I've heard. I've seen something on TikTok, and I think it's time to have a conversation about refinancing.
Right.
And so, yeah, you're bringing up things like my kids in their college, like in the next 5 years, am I going to have to pay for that? Am I going to have to pay for...
Yeah, is your car 20 years old and it's time to get a new one and you have to finance it, but you can't get a good,
there's so much more than just
there are just so many factors. And when I've told a lot of people, you're used to making this payment, so why don't you continue making this payment? Pay it down faster or take the money that you're saving and stick in a savings account.
Right.
Because you're used to making that payment and you can make that payment.
Right.
But also other factors would be, are you going to switch jobs? Mm-hmm. Have you been at your new job for, at least 2 years? There's just so many things that come up. Have you taken a pay decrease since we last did your, loan, to look at debt to income, things like that. So,
So if somebody refinances, is it always best to do a shorter term? I know because, you've been paying your loan, started at a 30-year loan and you're looking at refinancing. Is it typical for people to go to a smaller term, or do they usually go longer? What does that look like?
So what is kind of crazy is the 30-year rate that I have been pulling is almost better than the 20 or the 15, which sounds crazy because you would think that the 15 or 20 would be better than the 30. But in the past year, when I pulled the different rates, the 30 has been a better rate. So what I've told people is when they've come in there, let's double your payment for you to pay it off faster. Mm-hmm. That way, you're making a 15-year, you're going to pay it off in 15 years, but we're going to double it because your interest rate's better. Ultimately, it would be the goal to take it down from a 30 to a 20 or 15 so you could pay it off faster. A lot of people, it hits their debt to income really hard when you take it down to a 20 or 15 too. I am overly cautious with debt to income. We can go pretty high these days. Freddie will accept sometimes up to 50% debt to income. But I sit with people and I'm like, do you want to do that to yourself?
Yeah.
Do you want a vacation with your family? Do you want to buy new cars? Do you want to have a life outside of your home?
Outside of your mortgage payment.
So then I'm leading them more towards, let's do 30 years. And if you can pay it down and you can make principal only payments every month, let's do that. So that way you're not something happened and you lost your job and you can't make that high payment anymore. So usually I lean towards the 30 and tell people, hey, you can pay it down faster.
Yeah.
And especially since the rates have been pretty close on the 15, 20, and 30 years.
That's such good advice too, because then you're not stuck in something you can't afford.
Right.
Things happen so quickly.
Yes.
I mean, people lose their job. There's a death in the family. Things happen. So to not be tied into that shorter term with the higher payment.
Right.
And then say you get a huge bonus at work, you can always pay down.
Right. Anytime. You can come in and make principal payments anytime. That's what's good about, refinancing at a local bank. They can come in at any of our branches, talk to anybody and pay it down. It's not like they're sending a check to, all over the United States and they don't know how to tell somebody, hey, we're making a principal only payment.
Right.
So that is, a plus.
So let's use that scenario. Let's say someone was at a 15-year and they had some circumstances in their life where that wasn't very affordable to them anymore.
Right.
Do they have the ability to come to you and say, I'd like this to be now a 20 or a 30-year loan and refinance it almost backwards to where you can add more years onto your loan?
So you can.
Okay.
They can go up. So a lot of people do that when they almost want to do the cash out. I've seen people be at the 15-year and they're like, okay, we want to, take 50,000 out, but now we want to go to a 30-year term. Not something you want to do because you want to pay your home off. You want that to be your equity.
Right.
But it is an option. You could always go back. I mean, there's people that don't have loans on their homes right now that are coming in saying, okay, we've owned our home for 15 years, but we have all this debt right now. So we need to do a 30-year cash out refinance. They've owned their home 15 years free and clear, and they're coming in saying, we need money to live off of. So
wow. So it's really, and I think that concept is really interesting. We can talk about it more. So let's say my house was worth $100,000. It's paid off. I come to you and I'm like, I have debt elsewhere and the interest rate is way higher than it would be on a mortgage rate.
Yes.
I want to pull this money out and then pay that and then start paying you a lesser percent to pay back my home. It's really actually a great strategy for people.
So a lot of people are doing the cash out refinance because vehicles are so much right now. They're seeing I've seen between like 5 and 12% to go out and buy a new vehicle. So, I mean, if you're thinking, oh, I can get in at a 6.5, why not take the debt out on my home instead of paying 11% on a vehicle or, 28% on a credit card or 32% on a credit card. Or a lot of people take the equity out for their kids, for their college, things like that. So they don't have to pull the student loans. But it is smarter financially. And that's what usually when I pull the credit report, if people come in and say, hey, we want to do a cash out to pay down our debt, I look at what their current payments are with that debt. And I say, hey, we're going to cut $500 a month off of what you're paying to the credit card companies and things like that. So
people don't realize with credit cards that rate fluctuates. It's not always like the interest rate you got when you signed up for those credit cards.
Right.
Yeah.
And then if you're late one payment, I mean, that just blows you out of the water for your interest rate on things like that. So it definitely
then hurts your credit. I mean, all of it. People just don't understand the ripple effect.
Right. So it's so beneficial to come in and get that 6.5% or 7% and pay those things off. Your payment's going to go down. So that's what a lot of people are seeing these days that have owned their home outright. They're like, well, we have other debt, but let's take our home as collateral because the interest rate's going to be so cheap compared to what we're paying.
Right. So we keep mentioning this cash out refinancing.
Yes.
Are there other types of refinancing available?
Right. So there is, just the basic streamlined refinance where you're just coming in to refinance to get a lower rate. You just want a lower rate. You want to lower your payment a little bit. There is that. So that's when I make sure, you're a full percentage point under your current rate. There is the refinance to remove the private mortgage insurance. You're like, okay, my home's going to appraise for more now. We have that 20% equity and I want to get rid of that, payment. There's also a lot of people, not necessarily a refinance, but there's a lot of people coming in right now to do lines of credit as well too, which that follows the Federal Reserve prime. That changes, whenever they change prime, that changes as well. So a lot of people are doing that because they're like, we would like to have that, open line of credit for 10 years because that's something else that's still, it'll be available for them to pull off open for 10 years. And that just gives them the extra money, kind of to pull out. So definitely a lot of different, usually we sit down and we're like, let's see which one works best for you. Like what options you have and which refinance works best for you.
I'm kind of stuck on the PMI. So okay. So you said if someone, I think people, like getting reappraised and the value of your home going up is really interesting because it essentially what you said adds equity that you didn't really put in there into your home.
Right.
And so how do people, I guess, find out that maybe their home is worth more? I mean, naturally, we know that the value of homes appreciate, but at what point would someone decide to get a reappraisal? And would that be worth it for them to
So
see if they can get out of PMI?
Usually, I believe they have to wait at least a year for that new appraisal to come through to get rid of the PMI. So usually you're just thinking like, look at the market and see what other homes around you have sold for. And you're thinking like, my home's gone up in value, it has to, I should have that equity in there now.
Great.
Let's get it reappraised to just get rid of that PMI. So, it happens a lot. I mean, especially with real estate today.
I never would have thought of that. I just learned something today. So that's great.
It's gone up so much. So, I mean, and think about if you move in a house and you're like, I'm going to redo a bathroom. I mean, you've already raised your appraised value up. So the possibility that you could get rid of your PMI, by doing little things like that.
That's great.
It'd
be worth it.
It is.
For sure. Let's walk through the refinancing process. So like, what does that look like from the moment somebody considers it to the closing and all of that good stuff?
Okay. So first I will have them fill out an application for me. I can either email it to you. A lot of people come through the drive-thru and get it, or I can meet with you and help you fill it out. I make it super simple for the people that come in or come through the drive-thru. I actually highlight every part that I need because it is a big packet and it is overwhelming for a lot of people. The first time I went through it, I tried to fill it out because I was like, I'm going to fill it out to see how long it takes me. And there's a lot of information.
You have to dig for some of that information.
So
like, what does this mean?
I mean, no one, they're like, I don't know how much I have in my 401k or I have this that, they don't know everything they have out there. So I highlight the basics of what I need from people. I ask them to, bring in, there's things that we need brought in, 1 month of pay stubs. I always make sure that they've had a job consistently for 2 years or been a student, because that is a big one to get a fixed rate. Like, I need to know that you were a student or you've been employed for at least 2 years without, a lapse in employment. 2 years of your W-2s, 2 years of tax returns, because some people don't tell you that they do a side business. So they're like, we're golden, we're good. And then you pull up in their tax returns and you're like, oh my gosh, you lost this much money because you had a side business and you don't want to pay that many taxes. So I always ask for 2 years of tax returns. I ask for their current homeowner's insurance and their tax bill. So once I get all of that, I input it in the computer to see if, they're approved. Usually I do this within like 24 hours because people are like biting at the bit. They're like, are we going to get approved? Are we not going to get approved? And I would hate to wait too. I'm not a waiter. I'm an anxious person. So I'm like, I don't want to wait from like a Monday
rates
to
fluctuate
Friday.
too.
Like get locked in.
Right.
Yeah.
So after that, we send out what's called earlies. We have to send those out within 3 days of approving somebody. Those are just estimates of what your closing costs are going to be. That's also an estimate of what your rate is going to be unless we've locked it. Usually we try to lock it as soon as we know that you're approved, unless for some reason it's like rates are going to go down and we have a feeling they're going to go down within like a week or two. But like you said, you never know because they've been fluctuating so much with the market that you never know. So once you send out earlies, they look at the earlies, they e-sign now, which is really nice. All of their documents, I get that back. I usually ask them, if they're ready for their appraisal, if there's anything in their house they need to, fix or clean up before I have an appraiser come out. I order the appraisal. The appraiser comes out, does the appraisal. I get the appraisal back. And then I order title work just to make sure there's no liens, nothing like that. Once all that comes back good, we have to send out a closing disclosure. And those are your final figures. That is your title expenses, your appraisal, your loan fees, everything final, what you're going to get back if you did a cash out, what you have to bring to closing if you're paying for your closing cost out of pocket, your final payment, everything. And they have to e-sign those 3 days before we close. We have to give them 3 days. And then after that, we go to closing. And if it is their primary residence, which usually it is because we're refinancing, we have to wait 3 days before we can release any funds. They have 3 days to rescind the loan too, which a lot of people don't realize because they come into closing. They're like, we're getting the money today. We can pay off everything today, or we've got everything's going to be done today. So if it is your primary residence, it is a 3-day rescission. So they have 3 days to call us and say, we don't want to do this loan anymore. And then if we don't hear from them for the 3 days, then we can release funds, pay off their existing loan, things like that. But a lot of people don't realize there's that 3-day waiting period.
Well, and a lot of people don't realize they have to be reapproved for the loan.
Right.
Right.
And it changes a lot.
So you could be in a 30-year loan. You're fine. You're in that loan.
Right.
And you want to refinance. Well, you might not qualify to refinance.
Right.
So that's kind of scary.
And
too.
that happens because people have changed jobs, or they've lost jobs, or they are taking less, or their debt's gone up dramatically too.
So after someone, you go through, do all this paperwork, and it's like before the 3 days that you're talking about, does someone owe still basically I guess the closing cost is what it.
Right. So if for
they
someone
can
were
still
to
have
back
to,
out, yes.
they still have to pay the closing costs and they didn't even go through on it.
So I've never had anyone back
good.
out. Thank goodness.
Because that wouldn't be worth it.
No. But I have had people back out mid-loan. So if the appraisal's been done, you still are going to owe for the appraisal.
Right.
I still make sure that you're going to pay for the appraisal because it's yours. It's in your hands now. We've given it to you. It's something you can go off of. You should still pay for it.
Right.
It's not our responsibility to pay for it. That is why I always wait and order title work after I get the appraisal back, because there's a chance that your house has gone down in its appraised value and you're not going to get what you want out of it. So, I always order title work after everything is good with the appraisal, because if you back out after that, then you owe title work. So then basically you owe every fee, every closing cost, but the bank's fee. So basically we've worked for free up until that point. And if you back out, we don't charge our fee, but you've still got title work and appraisal to pay for, which could be over $1,000.
Yeah. Usually appraisals are like what, $1,500 around that.
So they are like $500, $450 to $500,
Okay.
and then title work's usually around over $1,000.
Yeah.
So
So
it's a big expense.
Yeah. And it's still the same process as if you were to do an original loan.
Right.
Sounds like.
Right.
Yeah.
So everyone talks about rate. I know we talked about this at the beginning, but like, what are you seeing with rates right now? It's end of October when we're recording this. So
Right. So a month ago, I would have told you to start looking at the refinance process. I would say like, okay, we're going down.
yeah, everyone
Rates
got really
have gone
excited.
up. Yes, everyone
It's like a
got
whole thing at the
excited.
bank. Like,
Everyone's calling that is done, their loans for the past 3 years. They're like, we're ready to refinance now. And it just didn't play out kind of like we thought it was going to. Now we're hoping, by the end of the year, beginning of next year, we're hoping to see, a lot more refinances. Rates go down after the election. We all know how elections go with rates and the economy. So, unless it's a dire need right now. It's something that you really need. Most people are going to wait until the end of the year,
Wait it
out, because I would hate to do a refinance for somebody right now. And then come January, rates have dramatically gone down and turn around and say, hey, we're going to have to refinance your loan again because they've gone down and it's worth you doing. But then you're going to have to pay your closing cost again. Because we can't reuse your appraisal, even if it's, 2 months old.
Oh, good to know.
Reuse it for the fixed rate market. And I'm going to have to redo title work because they're going to question me if your title work's 3 months old. They're going to say, hey, there could be new liens out there. There could be things on it.
Yeah.
So then you're paying your closing cost, twice in a 6-month period. So I'm telling people to kind of hold tight because I think they will go down. I think it's just going to be after the election, the holidays, things like that.
Yeah.
And that's the thing. Like, I feel like you never know. I don't think anyone could have ever predicted when they went down to like whatever 1% or whatever. I don't know.
People in at a 30-year at 1.875.
Oh my goodness.
What a dream.
I wish that was my loan.
If that was me, then the bank would be owing me money. Yeah.
Will never move from their houses because they're like, I'm at a 1.875. I mean,
right.
You can't beat that.
No.
But we say that with the hope that they're going to go down after the holidays.
Uh-huh.
But you just never know.
That's the hard thing. You never know.
At people, that 20 years ago said, well, I bought my first house and I had a 15% interest rate. This is great. A 6.5%, a 7%. I don't know what people are complaining about. So, it's a different time where people expect the rates we had 5 years ago. They expect those rates.
Yeah. Mm-hmm.
Do we see them getting that low again right now? No, we do see them getting low, but it's a ticking time bomb. You just never know. You do have to get in at the right time. And that is something like my current customers that I have a list that I go over once a week of like the current rates that everyone has. And I check them every week because I'm like, what person is going to benefit this week? And there have been people that have benefited right now, especially if they have an adjustable rate mortgage. And I didn't talk about that, but if their rate is changing, if they're at the term where, they're at a 3-year adjustable rate where their rate's going to go up or fluctuate, it benefits a lot of people right now with those kind of loans to do the refinance, to get in a fixed rate. The adjustable rates were a little cheaper. So now it works for them to refinance. So it's just all about having somebody like look out for you and call you, because honestly, who is really actively looking every day at the fixed interest rate market?
Yeah.
I mean,
right. And if you don't know about it, and I would expect my lender to just watch out for me and call me. And there's probably other banks where these lenders are like, we're just going to keep them at this rate. So I think it's great that
Well, it doesn't benefit the bank any to do that. But
no, and it doesn't benefit. I mean, why would they come back to us if we're not going to contact them and say, it's going to save you this much money to refinance? Like, now's the time. If you feel comfortable, now's the time. So, I mean, it's worth me having those rates and looking at them every day because, there might be some family that's struggling and needs that extra $200 a month. And that's, $2,400 a year and something, super helpful.
That's your daycare payment or whatever.
Right. Right. Yeah. Yes. So I think it's just all about having somebody to look out for you too, having somebody that cares. And the local banks, a lot of people are doing it on the internet these days. They're not going to be the ones that reach out to you to tell you like, hey, you're at an 8% and I can get you into 6.5 right now. Like, let's go. Like, give me your stuff. Sometimes I tell people too, I'm like, I don't even need your application. Like, if anything has anything changed? And if they're like, no, we're at the same job, everything's the same. I'm like, okay, we're going to go off of your older one and I'm going to do it all. Just send me your stuff like as fast as you can so I can lock you in. Yeah. So it does help to have a local person do that.
Yeah,
for sure.
So if someone wants to get on Taylor Abney's call list for when these rates are fluctuating, how do people get a hold of you and where are you, Taylor?
So I am crazy in and out all the time. People are like, you're always in and out, hard to catch. So I do give my cell phone number out. I do tell people, I'm in the office Monday through Friday from 8 to 4:30 ish. I'm in and out all the time. Fridays, I work from home. I stay home with my kids and I work from home, but I'm still available on my phone, checking email, text messaging. You know, I tell a lot of my people, text me at night. Like if you have questions, like I don't care if you text me at 8 or 9 o'clock at night. That's usually when I like am in my mode to work.
Yeah.
So I'm like, if I text you back at 11, I am so sorry. But like, I usually just tell people, reach out to me on my cell phone. They're on my business card. My cell phone number's listed everywhere. It's where you're going to find me the most. Or, you know, come in. I am one of the only lenders that does not require you to set up an appointment with me. So if you come in our lobby, say you have 15 minutes to run in and talk to somebody about, you know, a loan, I'll get you in. As long as I'm not with somebody, it's too hard to set up meeting times these days to like know with like everyone's busy schedule. So I think that is something really nice about the Harrisburg branch is that, you know, you come in and you can talk to a lender. You don't have to have an appointment. So lots of ways to find me. Definitely.
We'll put that all in the show notes too, all your info. So people can get a hold of you if that's okay.
Sure. Yes.
Yeah. I've learned so much today. I didn't realize there was so much to refinancing, and it sounds like it's just like an educational piece that people need to talk about. So this has been wonderful. And I've learned so much.
Thanks for being on, Taylor.
I appreciate it. I hope I explained a lot. I'm happy to explain more, you know, if people want to reach out to me, and I'm happy to even look over when it would be beneficial for people to refinance. If they know that it's not right to do it right now, at what rate is it going to be beneficial for them? I'm happy to look over their numbers and figure their interest saving and things like that. And I do think it's good for people right now to look at their current debt and see what percentage they're paying on with their credit cards and their car loans and say, hey, I have equity in my house. Like, let's save some money. And I'm happy to look over stuff like that and figure out, you know, how much they're going to save each month by having one payment.
That's great.
Yeah.
Awesome. Thanks again, Taylor.
Definitely. Thank you guys.
We'll see you next week.
All right. Bye.
So Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.